So what are our benefits for buy and hold? So you
get cash flow.
Yeah.
That's the one that everybody loves, myself included. But there's so many other benefits that don't go quite as
aren't as sexy, maybe
aren't as sexy. I think that's cool. Although I would argue that they may be more sexy.
The highs with the lowest lows. That's like these days. World chain doggy on lockdown. Phone call 3 ways. I just pray that he find God now. It's no replay. On my way up to the top now.
So one of the things I think is interesting is we get asked a lot about, buy and hold strategies and why that's better, worse, different, than wholesaling, than fix and flipping. So that's always interesting to be able to share a point of view on something like that.
Well, I agree. And what I try to tell people, or hope they listen to me on, is the fact that there isn't a wrong answer there. Each strategy offers its benefits. Buy and hold seems to be the most popular because, at least on the surface level, it's the least time intensive. So we're approaching passive income.
You mean real estate's not a passive business?
Well, it's passive as long as you do everything you're supposed to do.
Right.
Which includes a lot of work.
Take a lot of time to get everything set up.
That's right.
And then sit back on the beach and drink Mai Tais, right?
That's the supposed dream, right? I don't know. I'd be bored. Like, I would love it for maybe a month, maybe 6 months if I really wanted to do it. But
right.
I think eventually, I have to do something. I get jittery and I get irritable.
I don't know what retirement would look like. That doesn't sound like a lot of fun.
Well, you're a hell of a lot closer to it than I am. So let me know when you get there, okay?
We're starting with the age jokes already.
You get your dad jokes in, I get the age jokes in.
Fair.
But jumping back to buy and holds, I think it's probably the strategy that fits the most amount of people. Fixing and flipping is a very hands-on, attentive business. Can you do it pretty passively? Yes, but you have to put a lot of trust into people and have your systems really robust.
And we know how well this past week, we know how well that works out, right?
Well, thankfully there's always something to make a little bit more efficient. And it's been a challenging week in that regard.
It reminds me of one of our mentors. No one's going to treat your money like their money, right?
That's exactly correct. And we've learned that the hard way a couple times.
But I mean, buy and hold, the benefit for buy and hold investing is you can actually do that while having like a full day job, while playing with the grandkids, like whatever the thing in your life is. All the other things that we do, so fix and flipping, wholesaling, those are really like other jobs, right? Like you really need to be active in that business.
Absolutely.
To at least get it off the ground anyways. There's certainly friends of ours who have grown those into more virtual type businesses where they're managing and overseeing and stuff. But for sure, initially you're the one swinging the hammer, you're the one doing the things. So,
and I think the point of that is that you need to learn what you need to learn before you can tell someone else how to do it, right? But you don't need to tell someone else how to live in a home. That's completely on them, which is another enticing part of buy and hold.
Right. So what are our benefits for buy and hold? So you
get cash flow. That's the one that everybody loves, myself included. But there's so many other benefits that don't go quite as
aren't as sexy, maybe
aren't as sexy. I think that's cool. Although I would argue that they may be more sexy. You have principal buy down. So instead of you being responsible for paying down your mortgage, the rent payment you receive is paying down your mortgage, and that is building equity each month.
So I get cash flow right off the bat, which is some actual dollars put in my pocket.
That's right.
And then how does the equity buy down, like the mortgage payment, how does that get credited? How is that thought about?
So let's say that let's make it easy. Let's say you're renting it for $10,000 a year. Okay. Obviously broken into monthly payments, but let's just say you're renting it for $10,000 annually. That mortgage payment is, even though it's in your name, technically the renter is the one that's paying it. The renter pays you, you pay the mortgage company with that cash flow built in. So after that year, there's a $10,000 equity growth between what the property's worth and what you owe on it. So over time, the more the renter buys down the mortgage balance, it gives you the opportunity to have access to capital in the property through refinancing that you didn't have to pay yourself.
So even if my property doesn't increase in value at all, my equity can grow in a given year, in your example, by $10,000, just by the amount of money that I'm paying on the mortgage payment that is applied to principal, all with dollars that aren't my dollars.
That's exactly correct. Now, the one caveat to that is if you buy the property cash or if you don't no longer have a payment, that benefit goes away.
Sure.
But I'd say, we obviously enjoy leverage, so we're never going to put ourselves in a situation where we have 100% equity in a property, right? But there are people that there's so many benefits to not having that mortgage payment from a cash flow perspective and other things as well. So that's a personal preference type situation.
So we talked about two benefits. So cash flow is one, and then equity buy down or principal buy down is two. So what are some other benefits that buy and hold investors see that maybe other verticals of real estate investing don't enjoy as much of?
So the one that is the most beneficial long-term is definitely appreciation. And obviously, if you are living in California, you know a lot about appreciation. And if you're living in the Midwest, maybe you know a little bit less about the appreciation growth over time. But we can get into why being in both markets is amazing. But appreciation is what you don't have to do. You just live your life, and over time, inflation, things become more expensive, higher demand, value just goes up.
That's awesome. So we buy a property today, it goes up, say, 6% a year over a given number of years, and then all of a sudden we pick up our head and we go, hey, we've actually got some significant growth of our equity in this property, all while the tenants live there and paid for the expenses and the utilities and the upkeep and all those things.
That's exactly right. And one thing I'll personally add is, at least the way I try and approach it, and I know you try and approach it the same way, is appreciation is not something we like to assume is going to happen. I think appreciation is viewed similarly to, on a very generic level, the stock market, and the fact that you can have 8-year growth one year, you could have negative 2% growth the next year, and it averages out over time. So if you're in California, and again, they're kind of on their own out there, but you can maybe bet on it a little bit more. Although recent trends say maybe that's a less of a secure bet, but at least where we're at in Charlotte, appreciation is not something that we are banking on happening in, broad terms.
So when we're underwriting a property in our business, we never make an assumption about appreciation. Obviously, we have an understanding of the real estate market and an expectation that over a very long period of time, 10, 20 years, we are probably going to see appreciation. Chances are probably pretty good for that, but we'll never write it into our underwriting.
No, and at the same time, obviously, there's always that flexibility where, if we're close enough, obviously we understand that the long-term projection is appreciation. But if we're only planning on holding this property for 2 years or a shorter period of time, it's definitely something we're not going to include.
And everything else has kind of got to drop into place. So the cash flow numbers, all of that type of stuff.
Bingo.
Our cash on cash return, how much cash are we putting into it versus how much is coming back out.
Yep.
So those are three of the benefits. So we talked about cash flow. We talked about principal buy down, equity buy down. We talked about appreciation. So there's one more major benefit.
And the best thing about this one is it's really not your responsibility other than to hire someone who makes it their responsibility. And that's just tax benefits. So I think you and I can both agree that finding a tax attorney's not the right word there, CPA, bookkeeper, all that stuff is a challenging part early on in the business because you want someone who understands real estate as well as just generic tax forms bookkeeping. So being able to have depreciation and then being able to have your bookkeeper or CPA tell you can write portions of this off and all the other things that I'm not going to personally suggest because I'm not a certified, public accountant or, anything like that. But tax benefits is the last one that we probably overlook because it's something that we're just used to paying.
Right. So in real estate, we can make actual cash, like deposits into our bank account.
That's right.
We can
Cash
grow the value of what we're holding by principal buy down
Yep.
and appreciation. And even in spite of all of that, on paper, often real estate businesses will actually show a loss because of depreciation.
Absolutely, especially if you hold a lot of them. And what I think, you mentioned this almost unintentionally, but at least the last year and a half, what was really cool is that when you get the principal buy down, no matter what, when you have a mortgage, and you're seeing appreciation in a market, the benefits almost doubled. So like appreciation or principal buy down's going this way and appreciation's going this way. So we talked earlier about that $10,000 principal buy down. Well, we saw some of the properties that we hold go up $30,000, $40,000, $50,000 in value just in the last year. And was that a crazy market? Absolutely. But we could have had that opportunity, and we did in some occasions, to refinance and pull out that $60,000+ just because the principal buy down plus the appreciation created such a large spread.
And you're kind of like foreshadowing into, it's not just one rental, right? It's multiple rentals, and it's a system that's often described as like BRRRR. So you're gonna buy it. Let's see if I get my R's right.
Yeah, all right. Brandon Turner's listening here.
I know, right?
Let's see what you got.
Rehab it,
Yep.
rent it, refinance it, and then we're going to repeat. I think I got my R's, but
got 'em right.
there's some others in there. People throw them in. But so we're going to do that time and time again. And so to your point, when we refinance out that equity and then we get to put that back into work to buy more assets, to grow the base of the business, that's when it gets really, really exciting.
On my way up to the top now. That's on